Hello everyone, welcome to today's lesson. Today we will be talking about order types on Binance exchange. While Binance offers many different types of orders, we'll be focusing on the most common used ones, limit and market orders. As they are essential for spot trading, we will be discussing futures market in the next part of our course. So, what is a spot market? To start, let's define what the spot market is. The spot market is where you purchase an asset directly into your portfolio. If you buy a token and the price goes up, you make a profit. If the price falls, you lose your money. Or wait until the price returns. So basically you purchase, you own the asset, and then you decide if you want to take profit if there is a price jump, or you want to keep it and use the technology or maybe some other utilities that this token has. Now let's talk about how to access the spot market on Binance and go over some key parts of the user interface. To access spot market, you will need to go over here to trade and select spot. This is our user interface. First, you will see trading pairs like BTC, USDT. This means you are buying Bitcoin and paying with USDT. The first asset is the one you are buying and the second is the one you are paying with. Over here we have our order book. The order book is divided into sellers at the top and buyers at the bottom. If you want to buy instantly, you can click on the active price like this. You can see our price has changed and the order will be fulfilled immediately. So it's basically like doing a market order in this case. What is an order? An order is simply a command you give to exchange to buy or sell an asset. There are several types of orders you can place, so let's explore the key ones. The most popular order is limit order. A limit order is perhaps the most popular. It allows you to set a specific price at which you want to buy an asset. However, it's important to note that the completion of a limit order is not guaranteed. So here how it's work. Let's say we would like to buy Dogecoin. Let's go to Dogecoin. Over here you can see now I'm able to select Dogecoin with USDT pair. Okay, so here is our Dogecoin. Let's say you want to buy Dogecoin at 0.08 cents. And we want to buy how much? 93 Dogecoins. This means if Dogecoin price drops to 8 cents, your order will be executed. This is great for those who don't want to constantly monitor the market. You can set the price and walk away. So let's create our order like this. Our order has been successfully created, and over here you can see that we have our order to buy Doge with our USDT at a price of 8 cents. The amount of Dogecoins we should receive if the price drops will be 93. The amount we use for this is $7.44. And if you decide to cancel your order, you can cancel it over here and you will not pay any fees. So let's cancel our order. Similarly, you can use a limit order to sell. This is a great way to fix your profit. For example, if you bought Doge at 8 cents and want to sell it then, when it reaches, let's say 12, you can set a sell limit order like this. Let's go 0.12, and here we will sell, let's say 80 Dogecoin, but we don't have them on the amount. We'll need to buy it later, and it will execute when the price reaches the level. Limit orders are ideal if you want to buy or sell at a specific price and are willing to wait for the market to reach your price target. Next type of order that is really popular with new traders is market. A market order is a very popular among beginners because it allows you to buy or sell an asset immediately at the current price rate. However, market orders can be less effective during periods of high volatility, as the price you get may not always be what you expect. It's a similar and fast order type, but may not be the best in rapid changing market. The pluses of this way of trading is that your order is executed instantly. For example, let's purchase some Dogecoin, buy. You can see that our order is executed and we have 65 Doge on our balance. The same goes for sale. We can sell our Dogecoin instantly. Over here, select sell Doge, and we have successfully sold our Dogecoins that we've purchased recently. So this is a tool that allows you to sell instantly on the market rate. The only thing, you should be careful when the volatility is high, because, well, with high volatility, bad things happen. So be safe. Now let's talk about stop limit order. Is a more advanced type, but very useful. It combines the functionality of stop loss and limit order. Basically, what does it do? When you select a stop price, this is your trigger. If market price reaches your stop price, for example, 11.5, your limit order is executed. For example, you want to buy for 12. Or if you want to buy for 8, let's say 8 cents, let's set our trigger for 8 and our buy price at 8 cents. Okay, so what does it say? Let me select some amount. So if the price reaches 0.85 cent, then open a limit order for 8 cent per one Dogecoin. And when we decide to buy, here we have our confirmation when we can see the same. Trigger at 8.5 and purchase is at 8. Here we have our total amount of dollars that we will use and estimated fee that we'll pay to the exchange. This type of orders is great for profit taking. So let me explain. Okay, so for example, imagine that you have purchased your asset over here, yes? And the price is going up and you are creating a stop limit order. How can this? For example, you say, if the price reaches this mark, sell over here. So for example, it's going up, and then starting to fall. Your order is being created and this profit will be in your pocket. So this is why this is really useful for profit taking, as well as purchasing coins at a specific price if the market hits your target. So let's go back to Binance. So stop limit orders are used for protecting profits or limiting losses by automatically buying or selling actions when certain price conditions are met. Finally, there are some more advanced order types that are not used as frequently, such as trailing stop and COC orders, which you can find over here. Over here. I would highly recommend starting with small amounts such as $10 to place a few orders and get comfortable with the process. Watching how your orders are executed in real time will help you develop your trading skill and build confidence in using those types of orders. Also, few things I would like to add. Over here you can see we have other data like change in 24 hours, high, low, and volume. This is useless data as well as market trades, because nobody cares how much anyone sold or bought at the moment. There is some applications on Telegram that can give you good information about big orders, but about those small orders here, basically you don't care. And over here we can select our coin and select the type of market we need. There is also specific markets for USDC and USDT. Let me close the doc. Okay, so you can see if you select USDT, only USDT pairs open. If you select USDC, only USDC pairs open. We will be working with USDC and USDT depending on the situation. This is the main currencies we are working with as our base currency. Another thing, this graph, we're not going to use it. You can use it as a trading. I think there was trading data. No, I think there was a trading view option here, but maybe, sorry. over here. There is a trading view option for this graph, but since we're using trading view for our classes, you will not be needing to do anything on this interface. That wraps up today's lesson on order types in the Binance spot market. We have covered limit, market, and stop limit orders. Each of those has its own purposes and use cases. So understanding them and how to use them is essential for successful trading. You must master limit, market, and stop limit orders. They are the orders that you will be using in your everyday trading. Also, I will upload a full study material on each order separately. Please go through those materials, study them, so that you understand the theory behind each order. That will help you a lot later. Feeling more, let's say, comfortable with the trading panel. Okay, so this is our classical menu. You probably remember it from our trading view of Binance Spot Market. First, I would like to explain to you what is the difference between spot and futures market. On the spot market, you buy a coin and become its full owner. As long as you store it securely, it's yours and no one can take it from you. You can think of this as buying a product from a store. You own it outright. Futures, however, are different. When trading futures, you are not buying a coin itself. You are buying a contract. Essentially, this is a bet between you and the exchange. Those contracts can be perpetual or have an expiration date. But the core idea is the same. For example, in our classes, we are using only, for example, in our class, we'll be using only perpetual orders since they are not expiring. Over here, you can type Bitcoin, BTC, and you can see that this is our unexpirable futures. And over here, you can see there is a quarterly delivery and B quarterly delivery. What does it mean? Expiry-based contracts have an expiration date. For example, you could buy a contract on Bitcoin with an expiration in the third quarter of 2024. When the date arrives, if your bet was correct, you earn a profit. If not, you lose your difference. On the other hand, we will be focusing on perpetual futures over here. Because I don't recommend you using expiry-based contracts due to the lack of significant advantages. Perpetual futures don't have an expiration date, making them much more flexible. Okay. So over here you can see we have selected our perp option for Bitcoin futures. Here is our price difference for 24 hours. And over here our indexes, which we don't care about them. But over here you can find something called funding and countdown. What is funding? Basically, what does it mean? If on the market shorts are more than longs, then the ones who hold shorts pay this fee to the ones who hold longs and vice versa. Pretty straightforward. Over here we have our 24 high, low volume, basically data you don't need. Over here is our order book, and over here we have our orders. Nothing special here. But on the top we have type of margin. Margin can be cross and isolated. You can see that in my region, since in EU it's some kind of new restriction, we cannot use isolated margin, we can use only cross. So what does it mean? Gross margin allows your entire account balance to act as a collateral. If you enter a trade with $100 and get liquidated, your entire balance could be affected, not just the initial $100. The way of trading that I'm using is isolated, and I will show you on the other exchanges when I have access to this feature how does it work. But the principle of the isolated margin is like this. Isolated margin limits your risk to the specific amount you've invested in a trade. If you enter a trade with $100, so you cannot lose more than that, unless you manually add more margin. I highly recommend using isolated margin because it limits your potential losses. That is why I'm using KeySex, since KeySex allows everything by default and doesn't have any restrictions based on my region. So let's select cross because we have no other option. And over here we have leverage. This is tricky part. Leverage allows you to borrow funds to increase the size of your position. For example, if you have $100 and you want to trade with more, you can use leverage. So let me explain what is leverage. Let's go here, brush. Okay, so imagine you have $100 on your account. but you're not achieving a fast result with those $100. Yes? You can go to the exchange, let's say Binance or any other, and ask them for, let's say, leverage of 10 hicks. So what does it mean? You have $100 and Binance will give you 10 hicks. With 10 hicks now you can trade with $1,000 and $100, where 100 is yours and 1,000 is given by Binance using the leverage mechanism. So how does it work? However, leverage accelerates your result. The higher the leverage, the faster you will reach liquidation. For example, with leverage 10, like this, a 10% drop in price will result in liquidation. With 25, only 5%. With 50, 2.5. With 100, only 1%. And about 125, I don't want even to speak. It's bad. And let me open one position to show you how does this liquidation look. Let's buy long. Okay, so over here is our position. You can see the liquidation price. Liquidation is the forced closure of your position when you lose all the margin you've invested. This happens when your trade goes against you and the margin supporting your position is depleted. To avoid liquidation, you can add more margin, which will move the liquidation point further away. In this case, we are in cross, so we are unable to do so, but with isolated margin, you will be able to do this. Let me explain how this works. Okay, so this is our position. For example, you enter over here, let's say with your 1,100. Okay. So we have entered here and we are going long, hoping that the price will reach, let's say, this position. But the price is trading and falls below our entry point and then below the current trend that we have here. So below our support, basically. So what will happen? You have your $100 and 1,000 from Binance. When your $100, let's say over here, will get depleted, so you are minus $100. Binance will close your position and your account balance will be depleted and they will return their money back to them. So basically you can trade with their money as long as you have coverage for them. When you lose the coverage due to some kind of market movement, your trade is being liquidated. So remember, leverage is not a magic solution. And I strongly advise you against using high leverage until we've complete our risk management lesson. Let's return to Binance. So when you are trading, your target is not to get at the moment the most dollars. Your target is to get the best percentage. I personally recommend you, if you trade Bitcoin, this is how I do it. I work with maximum Hicks 10 or Hicks 15. This is the leverage I use for Bitcoin. For other coins like Litecoin or some smaller coins, guys, from this to this. Hicks 3, Hicks 5. Hicks 5 for altcoin in some cases is a huge risk. So with leverages, you should be careful. The pluses from my point of view, the obvious benefit of futures that I can see, that you can profit from price increase and price decrease. This allows you to profit from movement in both directions, but leverages make it more risky. So please be careful. Also, over here you can set up your stop loss and take profit, which is obvious. For, let's say, take profit, let's do 69, and for stop loss 65,500. So okay, let's apply our stop loss. So you can see our stop loss has applied. You can also close your position using market order or limit order, which is, from my point of view, is pretty obvious. Market is instant close and limit will be closed on reaching some specific price target. That's it for today's lesson on Binance Futures. We've covered what futures are, how margin works, and the risk of using leverage. Always use isolated margin if you can to limit your losses. And be cautious with leverage, especially high leverages, as it can lead to quick liquidation. If you have any questions, feel free to ask me in the chat. Also, if you want to close your position, simply don't forget you can do it by clicking Market Close. and your position will close at the current market price. Thank you for joining today's lesson, and I will look forward to seeing you in the next one.